Stocks finishing the month with a whoosh higher into the close. Earlier, we got the Fed's preferred inflation measure, PCE, in line with forecasts for April. So will the Fed be satisfied with this reading, or are rate cuts still far away? Joining us now is Moody's Analytics Chief Economist Mark Zandi. Mark, welcome. Happy Friday. Guest earlier, Warren, told us that he thought that maybe the market was reading this PCE report too dovishly. What do you say?
I thought it was a good report, John. It indicates that inflation is on track to get back to the Fed's target I'd say by the end of the year, within spitting distance of the Fed's target by the end of the year. So it felt pretty good to me, particularly after the kind of disappointing numbers we've been getting since the beginning of the year. And I think all the trend lines here look pretty good with respect to inflation. So I took a lot of solace in the number.
So where do you need to look from here for confirmation of that, the next strong data signal that we get?
Well, we need more of the same. I mean, the Fed's focused primarily on the inflation statistics. And so I think there'll be another couple, three before. I think they'll probably cut in September. So they'll get 2, 3 more inflation statistics before then. So we need, 0.2 on a month-to-month basis. It'd be great if we can throw in a 0.1. That would be nice. But I think, we'll get that or something close enough to that the Fed will be able to start cutting rates at the September meeting.
I mean, we know inflation data is backward-looking. We know the shelter component, this is particularly true on the CPI side of things, is outsized and also lagging by quite a number of months. I mean, how real is the risk here that the Fed is behind the ball?
Morgan, if I were on the Fed, I'd be cutting rates. I think they've achieved their goals at full employment, the 4% unemployment rate, sub 4% now for more than 2 years, and feels like we're there. And I think inflation is, close enough to target. And as you point out, if you exclude the cost of home ownership, the so-called owner's equivalent rent, which is very difficult to measure in good times, but in a time like this when the housing market's topsy-turvy, all but impossible. But if you exclude that and you go to so-called harmonized inflation, that's at target. I mean, I think we just did the calculation for harmonized consumer expenditure deflator. I think it came in at 1.7% year over year for the month of April. And it's been below 2 now for, I think, almost 6 months. So I think we're there. And if you've achieved your goals, you got to ask yourself the question, well, why do we need such a high rate, a 5.5% rate? The economy's resilient and strong. Yeah, I get it. But, why take the chance? The things can change pretty quickly. So I'd be arguing for cutting right now. I was arguing for cutting earlier in the year.
Yeah. Harmonized core PCE. We're going to start using that a little bit more.
Yeah.
Even as we're talking about the Fed holding steady right now and wanting to see probably several more months of better or improving inflation data, we have an ECB that is poised to potentially cut as soon as next week. How does that divergence now play out here globally, whether it comes to the dollar and what we potentially see in the currency markets, when you talk about the global bond complex, when you talk about the impact here in the U.S. as well?
Well, I think the markets are anticipating what you just said, that the ECB is going to be cutting rates here very shortly. The Bank of England, not too far behind. Bank of Canada, also not too far behind. That's in the markets. Investors expect that. So if that's the end of the divergence, I don't think it's any big deal. Currency markets will be stable. But, again, if the Fed holds on tight here, higher for longer, the divergence is going to continue to grow. And at some point, that will become an issue. And one more reason why the Fed may want to start cutting rates sooner rather than later.
Yeah, I mean, things being as strong as they are, I'm still surprised, you're saying September. Tell me more. Why not later? Just a little.
Well, by September, I think they get the data. Look, I think there's the debate about full employment that's been settled. We're there. They've achieved that target. The real debate is, are we at the 2% inflation target so that they can feel like they've satisfied their objective to everyone's satisfaction, particularly in an election year. I think the bar is a little bit higher. And I think they need a couple, 3 more numbers to be able to definitively say that. Now, having said that, things are moving around and will continue to move around. So we could see the economy start to soften a little bit. We could see some cracks in the financial system. We could see some problems in the currency market, like we were just talking about. And that would be, or the equity stock market could correct. I mean, the market's highly valued, feels a little vulnerable, so that could correct. So there's other variables that could change their mind and start for them to start cutting earlier than that. But assuming none of that stuff, assuming everything, roughly the status quo and everything kind of sticks to script here, I think they'll probably need probably 3 more inflation numbers that are consistent with their target before they actually pull the trigger and cut those rates.